Traders, if you are losing most of your trades and you are getting frustrated with the way the market goes against you, then you do not want to skip this video. You want to watch this till the end and learn some fantastic tips and tricks from a retail trader like myself who has made those mistakes and has learnt from them. So traders, sit tight, let's roll the intro and I'll see you over on the chart. Okay traders, you meet me here over on the chart and I have one question for you. We are looking at the Aussie dollar, Japanese yen, a fantastic pair which I'll get into. But my question to you is, what do you see? Take a minute, what do you see? Now, what I see is a mess. It's a complete mess. You've got moving averages indicators, you've got a smooth moving average, a 50, a 200 EMA, then you've got the Ichimoku cloud going on. Now they're all fantastic indicators in their own right, but put them all together and what do you see? You see an absolute mess. Now what I first suggest is you dial back your charts. You'll see so many traders out there that have 1,000 indicators going on and they cannot see what the market is telling them. Let's not forget that this chart is telling you a story, it's telling you how price is moving. And all you have to do is dial it back, get rid of some of the market noise, get rid of some of the indicators and actually understand what the market is telling you. So now I've taken those away, what can we see? We can see clear pattern. We can see a clear pattern to the upside. And going back to my original question of why I like this pair, and particular JPY pairs overall, is because they follow a nice pattern, which is the wave pattern. The push up, the retest or the retracement, and the impulse to the upside, and again the pullback. They follow the nice wave pattern. You can see this here previously. And when they do run, they run for a long time in that direction. So it's a good pair for beginners to get into, any JPY pairs for that matter. Now that we've dialed back and we've got rid of some of the nuisance indicators on there, let's break this trade down and understand how the market moves and unlock those secrets that most retail traders do not know about to avoid getting stopped out in the market and become profitable traders. So, into the analysis then. What we can see here is for the past good few months the market has been moving sideways. So you've analysed it on a clear level. Now draw in your own analysis on there. Don't just follow blindly what an indicator is telling you. Make your own indicators. And when the market tells you what to do, it's giving you hints and signals. You've just got to analyse it and decipher what it is it's telling you. So we can see the market has been moving up and down for a fair few months. We're looking at obviously on the daily. And what we want to see is we want to see a continuation to the upside. Or do we want to see a continuation or a reversal to the downside? Now, most retail traders will be seeing this and, you know, rule number one in trading is the trend is your friend. And that is absolutely correct. The trend is your friend. So we have an upwards trend here. So what most retail traders would do is they'd have a buy order above the structure, wait for it to break through this area of sideways movement and then continue to the upside. But guys, I cannot stress enough, rule number one in forex trading is know where the smart money, the institutions and the banks are making price go. I cannot stress that enough. Now the chart is telling us one thing and we need to also confirm that. Price action and forex strategy is all about confirmation. Now if we have a look on the chart, what is it telling us? It's telling us that the market is moving sideways. There's huge indecision in the market. You will have some retail traders who are day trading, will be selling at the highs and buying at the lows, which is what is causing this market to move. But what we can see for those people who like chart patterns is we can see a wedge formation in the fact that the market is moving up but failing to break above this area here. And that is a reversal sign, or a sign that the market is going to explode in one way or another. How do we know what way the market is going to explode? We check what the banks are doing. So if you're not a member already, head over to my Commitment of Traders Club and we'll go on the COT reports, the Commitment of Traders. This is what the banks publish every week, the positions they have opened and closed. If you're not looking at these, you're crazy. You need to understand where they're moving their money. They're the ones who make it go up or down. So we're trading Aussie dollar JPY. So first of all, let's check out what the Aussie dollar has been doing. We are obviously back testing here. Let's get rid of that, make things clearer. So we're looking at the 11th of June, so around the beginning of June. So Aussie dollar updated every week, as I say, 11th of June. So we'll look between the 8th, 15th perhaps, but certainly around the 1st to the 8th. What can we see on the Aussie dollar? We can see here that the banks and institutions have gone from having plus 3k net positions, so they've had more long positions opened than short, to dramatically having minus 9k positions. Now that's a huge jump from having their positions net long to now having them net short. And you can see there that overall on the 8th of June, they've had 57,000 positions to the short side, whereas before they had 56,000. But they've also closed out a huge amount of their long positions. So the shorts have remained same, they've been building those up as we can see, but the long positions have been closed out. Why are they closing their long positions out? Because perhaps there's an indication here that the market is going to reverse and go to the short side on this pair. Now the commitment of traders report are traded against the USD, so the Aussie dollar against the USD is showing signs of weakness. This pair is definitely weakening here. Now if we go over to the JPY, for that extra bit of confirmation, we are trading Aussie dollar JPY, so we want to see the strength of the JPY. So 11th of June, 8th again, we can see that the net positions, the JPY has been huge, in huge weakness for some time now. But what we can see, if we zoom it out and have a look, is that from the 8th of June, going back to the 18th of May, the net positions have actually increased. Now they're still overall short, the JPY is certainly weak, but the net positions have been increasing to the long side. And that shows us that the JPY is in fact strengthening its position. Forget above the top, we've not got there yet in our chart. So looking only at the date that we're interested in, this is the figure that we're looking at. So actually the positions have grown in strength, whereas the Aussie dollar has weakened. Okay, now with that information that we wouldn't have known if we hadn't looked at the chart and looked at what the banks are doing, we now know that the Aussie dollar is becoming weaker and the JPY is becoming stronger. So that tells us that there's a potential reversal in play on our chart. This is then confirmed by the price and wick rejection and price action structure. It's failing to break above the 185, which is a fantastically whole number. Banks and every retail trader loves a whole number. It's just the way it works. So it's failing to break above this level. We can therefore perhaps look to get a position in on the short side. But patience pays. We have to wait and find that confluence in the market. So we're looking at the daily. So if we were trading this live, we'd put it on our watch list and continue with another pair. But let's see how the days pan out and if we can get into any moves. So I'll see you in a minute. Okay, so what have we got here? We've got huge momentum to the downside. Now this isn't unusual, we did see it around this area here, albeit there were some signs of bullish momentum, or certainly trying to fend off the bearish momentum. But here we've had a huge impulse to the downside. We have technically broken, but if we want to be picky, we've not yet broken it. So we want to see that break and retest. So for those of you who want to see that, we want the market to push down, retest this level, because we know that this pair likes to do a break and retest, and then we'll catch our entry there for the downside if the market works out to our analysis, which sometimes it doesn't, but most of the time if we are competent it will. Okay, fantastic. First sign that our analysis is correct. The pair has become weak, or the Aussie dollar has weakened, and the money is moving now to the downside. Some of you may be saying, well, Lucas, why didn't you enter a position up here? We'd have capitalized on a huge amount of pips. Yes, we would have, but again, we're trading a business here. We're not gambling. You want to have those support of your analysis that the market is doing as you anticipate. You want to react to it rather than just gamble and say, well, I've got a 50% chance of winning. There was no entry reason for us up here unless you were day trading. If you're day trading, your strategy is, here's a particular area of resistance, we'll enter a trade. But our strategy as swing traders and patient traders is we need an entry reason. Are we on our way to an entry reason? Absolutely. We want to catch that retest and then we'll enter. So let's see what happens over on the daily one more. We'll see if we get a retest over that day. Fantastic, as if by magic, eh? We'll go down onto the 4 hour, that's where we monitor it. So we've had this retracement up to the upside, and we are now at our previous level of interest which we marked out on our chart. But what we can see here is that the market had this huge impulse leg to the downside. Now what we can expect is it to actually retrace deeper than anticipated. Now if we are just trading a basic break and retest, most people may have a trade open here, this area, for the continuation. But my trading strategy involves the Fibonacci, and I'll link the video up the top up here if you want to check that video out. So I'll draw a Fibonacci from the high, and I may even do it from the daily high to the low, and then go back onto our 4 hour. Why am I doing this? This gives me that extra confidence to make sure to see if the pullback is going to be deeper or a shallow pullback. Now at the moment we're at this 0.382 zone, and that is a good indication for us to enter a trade because it is a Fibonacci level. But as you can see, I've marked out the 0.618 zone. Why have I done that? Because most banks also trade this zone. Now what would be ideal is for the price to push back up to this zone, the golden number as I call it, or the magic number, and then us enter a trade from this level, confirming that the pullback is at the 618 zone from the previous high, and then a continuation to the downside. Why am I concerned and not entering a trade here? Because this has been a very strong impulse to the downside. People will have had short positions up here, and they'd have certainly taken their money down at the bottom here, which therefore means that price is going to start to rally back up to the upside. It just depends on how far. So what my trading plan involves, and if you haven't got a copy of that, join our club and you can get access to a copy of our trading plan, which is right there for you guys. So what I want to see is the market pull back here. Further confidence is this is a massive key level. So around this area we can draw it in as an area. This is an area of interest. Previous rejections, another rejection here which causes push to the upside, and again looking previous. You want to draw it as a zone. If you want to be a bit picky, we can even move that up to the proper high. Should probably be better. So let's see how the market plays out, and if I do see signs that momentum is now with the bears, then I'll step in. Okay, so it is pushing up. How did we know that? Well, unfortunately you don't. You can't. You're not Mystic Meg. You just have to stick to your plan. Now my plan involves coming back to the 0.618 zone. Some people may have had a trade open here. They probably would have been stopped out. Okay, although it was a nice clean break and retest. If you go onto the daily, you can see that we're not actually quite there, finished with the retest. So it's good to zoom it out and look on the bigger picture. And if we are looking on the bigger picture now, the daily has hit our zone. So let's see how we go. Okay, so we have in fact reached our 0.618 zone. My ears are triggered. I'm ready to step into this trade as soon as I get a reversal of bullish momentum. What we can see here is the buyers are starting to lose momentum. The candles are not as impulsive as they were previously, and we're having some weak rejections. We are also retesting this previous major level. So for me, this is good enough to enter a short position. I would do it just slightly below in case the market does continue up. We can get triggered in. And stop loss, I'm just going to have it around about here, a nice 1 to 3, which would in fact take us down to the previous low. So I've got good intentions that it will reach the previous low, as we are looking to now reverse. So we'll keep it like that, and in fact I may just widen my stop loss just for that extra bit of security. We've entered the trade. Let's see how it plays out. Fantastic. There we have it. Now, important points to take away from this trade is control your emotions. They will stop you out more times than you need to be, and I'm telling you that from experience. You're down here at this point, you're thinking Fantastic, Lucas. You are in the money. You're 106 pips in. Let's cut you out. Okay, you've cut yourself out at, what would that have been? That would have been not even a 1 to 2. So you're already failing as a trader, because you're not. If you don't have that 1 to 3, you can't afford to be wrong 7 times. If you're trading at less than 1 to 2, you've got to be right nearly 50% of the time, or over 50% of the time. It's not worth it. And also, we come back up here. We actually went into our stop loss. Didn't stop us out. We were nice and conservative with that. But your emotions are going to play some tricks on you guys. You just got to lock them down. Set a notification for down here on TradingView that you get notified when you do get kicked out of the trade, hopefully with a take profit, and just forget about it. Don't sit there watching it. It's not going to move in your direction by watching it. Going back over this, how did we know that the price was going to go to our predicted area? Number one, before you even look at the chart, look at what the banks are doing. Look at what they are doing. If you're not a member, head over to Commitment of Traders Club. We make it super easy for you guys to check out what the banks are doing. We summarise it nicely for you, and we also publish live signals so that you don't miss out on these opportunities. So step one, check what the banks are doing. Step number two, keep your chart nice and clean. You don't want to make it a mess. Read what the price and what the patterns are telling you. We knew that the price was moving sideways. We knew that it wasn't breaking above the 85 zone, which is a key number. We knew that the banks were going to step in eventually and push price to the downside. Why? Because the Aussie dollar was being weakened and the JPY had signs of strengthening. Therefore, a reversal was perhaps in play. And secondly, we know that this pair, from looking at previous, respects the wave pattern greatly. We took this as our key zone because we used the Fibonacci from the daily level. My trading plan allows for me to take trades on the pullback that comes to the 0.618 zone. I don't tend to like to take them around here for this exact reason. It just goes against you. Swing traders were looking for long-term trades, so make sure you stick to your trading plan in that sense and be confident. If you're wrong, you're wrong. If you're trading at 1 to 3, you can be wrong 7 times and you're still in the money. Okay, even if you're not a great trader, just be right 3 times out of 7 and you should be good. Guys, if you have any questions, leave a comment below. Please like hit that like button. It helps us immensely. Let us know what we're doing good. Let us know how to improve, and we'll see you over on the Commitment of Traders Club if you're not a member already. Have a great trading week, guys, and we'll see you soon. Peace.